Hello again and welcome to the channel that turns numbers into normal words. You are now familiar with the key elements of financial statements of any business. These are balance sheet, income statement and cash flow. So far we built each financial report one by one. Today we'll tie them together and see why every investor, manager or lender relies on this trio. All of them are connected and the numbers are flowing from one to another and everything stays in balance. Balance sheet tells us what we own and owe right now. Income statement tells us how much we earned and spent during the period. Cash flow statement shows us where the cash actually moved. Think of them as a movie trilogy. Episode 1. Balance sheet at the end of year 1. Episode 2. Income statement, everything that happens in year 2. Episode 3. Balance sheet at the end of year 2. Then comes the cash flow as the director's commentary showing where every dollar of cash entered or left between the two snapshots. These statements form annual reports of the companies, and for a lot of companies they are audited. That means the auditor checks them and confirms that they are correct. They are the source of truth to anyone who is interested in how the businesses perform. By the way, in addition to the 3 statements we have discussed, in the annual reports of the companies you will also find a statement of changes in equity. They will also include a few pages with additional notes and commentary which explain key developments of the business, but we will discuss that later. Let's drop the numbers of our Apple business back on screen. Here is an opening balance sheet, year 1. On the asset side we have truck of $150, inventory of $30, receivables of $50 and cash of $60. On the liability side we have a bank loan of $100, payables of $60 and equity $130. Now comes the P&L. During year 2 we sold apples for $100 at a cost of $50, paid $10 of salary and $5 of rent, and recorded $15 of depreciation. On top, we paid $5 of taxes. In addition to that, we also repaid $20 of the bank loan we had. That produced $15 in net profit, but resulted in a negative total cash flow of $15, mainly because we repaid a loan. So, in the result, we had a year-end cash balance of $45 after all movements. For the next year, we should set the target to generate even more profits, but also to improve our working capital management. Why? Because last year, despite the profits, we managed our working capital rather badly and had a negative $25 outflow. We paid our suppliers too fast or too much while still waiting for customers and investing into our inventory. And we can see that from our financial statements. What else? Balance sheet is a snapshot of financial health. Assets, the truck we have, mean long-term power. Inventory and cash mean short-term fuel. Liabilities, in our case loan and payables, mean outside funding. Equity is our owner's claim, growing with profits. And always a quick check. Assets must equal liabilities plus equity every day. Income statement tells us a story of performance. It starts with revenue, subtracts each cost, lands on net profit. Profit belongs to owners and flows into the next balance sheet equity line. Cash flow presents a reality check on liquidity. For example, operating cash flow, profit adjusted for non-cash items and working capital was only $5 in our case. Investing cash flow was 0. We bought no new truck. Financing cash flow was minus $20 because we repaid a loan. Sum was minus $15 and explains why cash fell from $60 to $45. Why does the trio matter? You can be profitable and still run out of cash. For example, payables too low, inventory too high. In addition, you can show great cash today, but still be shrinking if you sold off assets or stopped investing. Only by reading all 3 together you can catch the full picture. Start with the income statement. Is the business profitable? Jump to the balance sheet. Can it pay its bills? For example, calculate a current ratio. Can it handle its debt? For example, debt-to-equity ratio. Open the cash flow statement. Is operating cash flow consistently positive? Is investing cash flow negative for sensible growth or positive because they are selling off? Is financing cash flow paying down debt or piling more on? And some more quick sense checks you can do at home. Compare depreciation and capital expenditure or CapEx. Are we reinvesting enough? Look at receivables divided by revenue. Long collection times frees cash. Watch inventory days. Inventory divided by cost of sales. Slow apples rot and tie up money. Trace net profit conversion into operating cash flow. Big gaps need an explanation. Let's do a quick summary. Balance sheet means where we stand at a given point in time. Income statement means how we performed over the period of time. Cash flow shows how the money moved. You should read the financial statements together and not in isolation to get a full picture. Always reconcile to the bank balance. Numbers must add up. Now you see why these three reports are the unbreakable triangle of business truth. Next time we'll have a look at an example of the financial statements of a real-life company, Unilever. If today was helpful, hit like, subscribe and tap that bell so you never miss a lesson. See you soon!